Welcome back to the Tax Law Channel. I'm Scott Drake, and my guest is the tax lawyer with Wood LLP in San Francisco, Robert W. Wood. And an article we're discussing today in Forbes about a sharp increase in audit rates. Rob, welcome back.
Thanks, Scott. Good to be here.
And by the way, this broadcast is also sponsored by ATG Trust. When you say an increase in audit rates, Rob, that's very frightening. What do you mean? What are you talking about?
Well, the IRS, there are, of course, lots of old wives' tales about what prompts an audit and, what things you should or shouldn't do on your tax return, sort of how to hold your pen exactly when you're signing. I mean, I think people get paranoid. But statistically, the IRS does release information every year about audit rates. I think the good news, I guess if you take away the headline about an increase in audit rates, the good news is audit rates are still very low. I mean, still, generally speaking, your chances are less than 5% of getting audited. The big increase, though, is in people in the upper income sort of echelons. So somebody in the $1 million or more category of annual income has a pretty significant spike in audit rates.
So, and in your article, you say those with more than $10 million in income are heavily audited, and it's like 30%. So the Mitt Romneys of this world it's likely that they will be audited, but for the rest of us, mostly, we're probably okay if we keep doing what we're doing.
Yeah, that's right. And I mean, there are some things I think that I could point to as a tax lawyer that I think anybody who looks at the numbers is likely to come to the same conclusion that makes you more likely to get audited. A lot of things people, oddly enough, at the very low end of the spectrum, and there's been some controversy about this, the earned income credit, and again, these are typically low-income people, those people are heavily audited, and the government, the IRS, has been criticized for that. But most of our viewers are more likely, somewhere between the earned income credit and the Mitt Romneys of the world. And as you say, they're generally okay. One thing I would say, though, is Schedule C. Schedule C on a Form 1040, for those of you who don't know, is a proprietorship schedule. So it's the thing, Scott, we've talked about hobby losses before. Schedule C is the thing that when you don't have a business entity, don't have a corporation or a partnership or something that you're working for and earning wages from. Schedule C is if your kid runs a lemonade stand or you sell things on eBay. So you may be a wage earner and you may get a W-2 that goes on your W-2 income as wages that goes on your return, but you may also have income from a side business. That traditionally would go on a Schedule C. We'll come to find out, and this has been true for a number of years, that Schedule C is one of the most likely tax returns or pieces of tax returns to be audited. So. And I think there are a bunch of reasons for that. One is the hobby loss issue that I alluded to. It's something that the IRS has looked at for years as being a sort of little business. Maybe it's a business, maybe it isn't, but it's something where people tend to write things off on Schedule C. The government knows that, and they are likely to look. So if you can, you might want to consider structuring yourself differently so that you're not filing a Schedule C in the future.
That's a good idea. And would it be accurate, too, to say that many people have a misconception about audits in general, and every audit is not this whole return comprehensive type of long-term process, frightening, under hot lights kind of thing. A lot of times it's just, can you just support this particular deduction with some paperwork and help us out here? And that's probably the majority of the audits that people see.
Yeah, Scott, I mean, excellent point. Excellent point. The audit means different things to different people, and when the IRS is releasing statistics, when they talk about audits, and there's been some controversy about this too, sort of pro and con about what's effective, but what seems to be most effective for the government, and this is, I think, good for all of us as taxpayers, is primarily correspondence audits. As you say, Scott, most of it's not office visits, hot lights, a lot of fretting over what they're going to ask you. Most of it is, here's a list of things we don't understand. It may be quite targeted, like charitable contributions. You know, we see you've written off X dollars. We want copies of receipts and specifics. We need support. Or it may be something about rental real estate. You know, show us that you were actually active, that you were, you know, rendering services so you can offset your real estate losses against other income. Might be targeted like that. That's the overwhelming majority of audits these days.
Rob Wood is a partner at Wood LLP in San Francisco, and he is considered a tax expert and is the author of more than 30 books, and he writes frequently for publications like Forbes. Rob, always a pleasure.
Thank you, Scott.
And this is the Legal Broadcast Network.